Let's talk tapering, the effect on bond markets, plenty more besides. Craig Swanger is from FIIG Securities. He joins us now live. Craig, welcome into the show. A bit of a disappointment for bond investments that there was going to be a shift in tone. Did you detect it?
Look, I think we've got the new governor coming in now. Yellen's made her initial speech. You've got a bit of a tone set. Some people were looking for something dramatically different. Ultimately, that was very unlikely to happen. And so she's going to come in, have her own agenda, but that would have been well and truly flagged already because there's been a transition period. I think now what a lot of people are looking at is, okay, so we've got that behind us. The new year's started. What should my investment strategy look like? And a lot of the fund managers have been making commentary around the relative valuation of Australian equities versus international equities and what 2014 might look like given those valuations. I think when you put those two together, look at the Fed's activities and consider the fact that Aussie equities are relatively overvalued compared to international, bank stocks become a pretty interesting topic of discussion. And that's because, with quantitative easing over the last few years, it's been fantastic for bank shareholders. It's been a great run. International investors have been some of the international fund managers have been some of the largest investors in our banks. And on top of that, we've had the self-managed super fund investors chasing yield. Between those two, it's been a fantastic run for the big four banks in particular. But what happens when tapering starts? If it's been great, QE has been great for bank stocks on the way up, then the opposite holds true as well. As tapering begins, what's it actually going to mean for the share prices of our big four banks?
Well, how is Janet, because she's in the driver's seat now, how is she judging growth? It seems that, she's going to push for a more stimulatory outcome.
Yeah, she's going to be pushing for a more predictable outcome for markets. She's really looking for how can I give confidence back to markets after obviously a very shaky few years, necessary corrections that have been made, unusual circumstances putting so much liquidity back into the market. As we taper that off, it has to be done in a way that's really predictable. So it's this challenge of watching the economic data and making sure that they taper, which they have to. The addiction to cheap liquidity has to be wound back, but not doing it in a way that shocks markets because confidence is pretty fragile. Employment growth just isn't at the levels they need it to be. And markets are showing signs of quite a lot of volatility at the moment. The swings off the back of very small amounts of news are growing, so obviously the VIX is spiking. She needs to make sure that she can control that level of confidence on the way through the tapering process.
Okay, the RBA's response will likely be what, as the dollar holds comfortably above 90?
Well, the RBA obviously wants to see the dollar making a gradual decline into an area where we're more competitive. And the more we get news like yesterday's Toyota news is only going to strengthen that argument. But at the same time, they don't want it to be too fast. And the RBA has exactly the same problem that Yellen has. We need to make sure that the level of confidence we've got now stabilises. Confidence is the absolute key. So a rapidly falling dollar is just as bad as a dollar that persistently stays above 90. As easing is wound back, as we go through the tapering process, we should see, all other things being equal, the US dollar strengthen. And we should actually see, with less cheap liquidity in the markets, that the so-called carry trades start to unwind, and all other things being equal, the dollar should come back off that. But as we know, all other things are never equal. We don't control that, so it's a difficult path for the RBA.
Well, you wouldn't rule out further easing, given exactly what you've said, if that doesn't play the script.
If it doesn't play the script, then further easing is absolutely an option for them. They've still got a lot more capacity to ease than really any other major central bank around the world. It's just at the moment they've flagged that they would need to see some big shifts outside of what they expect.
Yeah. Hear you loud and clear. Thanking you so much, Craig.
Thanks very much.
We've got Chris McDonald on Lunch Money, 1300 30 34 35.